And investors gear up for bank earnings, which kick off tomorrow. Wall Street firms expected to post the biggest fourth quarter trading haul since the financial crisis. We'll look at JP Morgan in today's The Numbers Don't Lie. Plus, we're getting inside the Federal Reserve's head. More transcripts from the committee meetings in 2011 reveal the struggles at the start of the debt ceiling crisis.
Now let's look at where the major averages stand as we head towards the close. Bloomberg's Abigail Doolittle is standing by.
Hi there, Joe. Well, we are looking at modest declines for the major averages heading into the close. We have the Dow, S&P 500, and NASDAQ all down about 0.25% or more. But this really doesn't tell the complete story. We today did see some pretty decent intraday volatility at the lows. Both the Dow and the S&P 500 were down nearly 1%. The comp, or the NASDAQ, was down more than 1%. And this is exemplified to some degree by the Russell 2000, the small cap index, the growth area index, which is still down more than 1%. Near its lows, it was down about 2%. Now, some are saying that this could be the unwind of the Trump trade or the big rally out of the election. This chart, though, suggests that it's probably a little bit too early and yet too late to say this. It's #BTV 5556. And in white, we have the Dow. We see a nice rally out of the election. In blue, we have the 10-year yield, which spiked higher. That tells us that bonds sold off. And in orange, we have gold, which was selling off, but all are still holding those basic directions. But what we do see is a little bit of a shift. But the shift isn't so much around the Trump conference call yesterday, but it appears to be more around the Fed. We see that the 10-year yield is now down for its fourth week in a row. We see also that the Dow is starting to lose a little bit of steam, while we also see a really big rally there in gold. Now, the gold rally may look the biggest, but probably most significant is the 10-year yield. In fact, when we take a look at a 10-year chart of the 10-year yield, we see a massive move higher, 84 basis points. That tells us that over that time period, bonds were selling off. We do see, though, here, this is the little bit of congestion suggesting that perhaps this is reversing. But this big move up has, of course, caused a few big bond gurus out there to say that we may be looking at the end of the bond bull market. And I know that in the next hour, you will be having Scott Maynard of Guggenheim coming on to discuss this. When we take a look at a long-term chart of the 10-year yield that we have looked at before, and this is #BTV 5215. This chart suggests right now the bull market in bonds remains intact. This is basically a long-term chart. This is the entire downtrend in the 10-year yield as bonds rally. And we see that on the recent sell-off in bonds, $1.7 trillion on a global basis back in November, the top of this channel was touched perfectly. And this channel has been pretty reliable. It suggests we could see a move down. That's also supported by the RSI, or the Relative Strength Index, hitting up to levels that suggest that it is likely to move back down. In fact, a quantitative analysis analyst, Augustin Vera, he said the last 4 times since 1980, when the RSI reached to levels that it's recently touched, that it suggested a big reversal. So the bond bull market, at least for a few weeks or months, may very well remain intact, Scarlet.
All right. Thank you so much, Abigail Doolittle. What'd you miss? Senate confirmation hearings for Wilbur Ross as the new U.S. Commerce Secretary have been put on hold. But in the meantime, we can tell you that Ross is finding a strong ally in the U.S. steel industry. Leo Gerard is the international president of the United Steelworkers, and he is with us from Pittsburgh to talk about what is driving his support. Leo, great to speak with you. Thank you so much for joining us.
Well, thank you for being on.
Following the announcement that Mr. Ross would be the nominee for Commerce Secretary, you had put out a statement on behalf of the Steelworkers Union saying that the industry is smaller but more efficient than ever, and Wilbur Ross knows better than anyone that on a level playing field, our members are the most productive workforce on the planet. Your union negotiated a contract with Wilbur Ross's International Steel Group. Tell us a little bit about your experience with him.
Well, at the turn of the century, 2001, 2002, 2003, the domestic steel industry was in a complete crisis because of the flood of cheap imports from China, Brazil, Russia, and we had 40 bankruptcies. 2 of the major steel companies, LTV and Bethlehem, were in bankruptcy, and we weren't having a very good time finding someone to help us save those companies. Wilbur came in and was interested, helped us acquire those companies, helped him acquire those companies, and then he worked very closely with us. In fact, he said to our local union leadership and to our regional directors, "You guys know how to make steel. Tell me how to get this place started again." In fact, LTV had planned to close the steel mills in Cleveland down over the winter period, which would have really destroyed the mills. We got some court support. Wilbur came in, we put the mills back to place, and now almost 15 years later, we've still got people working in those steel mills, in particular in Cleveland and Indiana Harbor, and those places with Bethlehem and LTV, where thousands of people are working. And Wilbur was one of the people that helped pull that off with our union. So I respect him a lot. And during that period of time, he often articulated his strong concern to maintain strong manufacturing in America, and knew that manufacturing was the key to family-supporting jobs.
Wilbur Ross aside, I want to get your perspective on this administration as a whole. After the deal to save some jobs with Carrier, Donald Trump fired off a tweet blasting Chuck Jones, the president of United Steelworkers, 1999. What is the relationship overall between your union and this administration? Do you see it as a hostile one?
No, I don't, because like a lot of others, we'll work with him on issues, but on some other issues like Medicare and Medicaid, voting rights, and that we'll probably not be on the same page. But repairing and replacing NAFTA, repealing and replacing NAFTA, repealing and replacing PNTR with China, having a strong long-term infrastructure bill. Those are things the steelworkers were fighting for the last 30 years. So on those issues, if that's what President-elect Trump's agenda is, we're going to be there to help accomplish that agenda. So on the industrial manufacturing side, if he wants a strong manufacturing industry, we're going to help that accomplish.
What kind of overtures has anyone from the administration made to you or your union?
Well, there's no overtures being made. That obviously I've had some discussions with Wilbur. We know Peter Navarro very well. Bob Lighthizer, who's going to be the USTR, is someone that I've personally worked with and have a tremendous amount of respect for. Peter Navarro has done a movie and done a book called Death by China. Those are all people that we know that share our desire to have a strong manufacturing and industrial base. And I really get tired and annoyed when people call the industrial heartland the Rust Belt. If you ever go into a steel mill, you'll find that an operator in a steel mill gets 3, 4, 5, 6 years of training. And these aren't Rust Belts. These are sophisticated manufacturing facilities, and we're going to work with them to maintain them and grow them.
You mentioned repealing and replacing NAFTA. In your vision, what would be the key differences between what we have in place now and what an ideal replacement would look like?
Let me give you rather than try to do that, let me give you some statistics. Since the passage of NAFTA, we've accumulated a trade deficit with Mexico almost $200 billion. Since the passage of PNTR with China, we've accumulated a trade deficit of almost $3 trillion. With our trade deal with South Korea, again in a short period of time, a trade deficit of $162 billion. If trade deficits are so good for the economy, why does no other nation want one? So what we want to do is work with the administration. We're not against trade. We're for balanced trade. We're not for trade that's going to give away our jobs. And if we use Carrier as an example, the only reason that Carrier wanted to move from Indiana to Mexico is because they could pay workers a total of $6 an hour. I think it's the president-elect has the right idea. If you're going to manufacture furnaces in Indiana, move that to Mexico. Mexicans don't need many furnaces, and then sell those furnaces in America. You should pay a heavy tax for leaving and a heavy tax for trying to come back.
Leo,
and that will maintain jobs in this country.
Leo, I'm glad you bring up the trade deficit, because I wonder how confident you are that an infrastructure spending package will be passed here, especially as Mitch McConnell, the Senate Majority Leader, has warned against a debt increase that would come through a massive infrastructure spending plan.
Well, look, I think at some point Mitch McConnell and Paul Ryan have to come to their senses. All they need to do is get out of their bubble and travel across America and see how badly we need infrastructure. Our energy grid for transporting energy is decrepit. We lose more energy on the grid than we could imagine. Our roads and bridges, I live in Allegheny County, we've got dozens of bridges that are impassable with transport trucks. We've got all this infrastructure. We've got water treatment plants. And I was kind of annoyed when we passed a water bill just a few weeks ago that Paul Ryan opposed the domestic content provision in it because he had a small manufacturer in his congressional district that I think bought steel from China. So I think that it's important that we stand and fight and help the president-elect get a strong infrastructure bill that's going to last not 1 year, not 2 years, but a long-term infrastructure bill, that we find a way to fund it, and that we establish an infrastructure bank very much like they have in Europe, where they have an infrastructure bank that's continuing to invest in their European infrastructure and modernizing it. So I'm prepared for that debate, and again, Mitch McConnell and Paul Ryan ought to get out of their bubble and see what the infrastructure in America needs.
All right, great stuff. Thank you very much, Leo Gerard, International President of the United Steelworkers.
Coming up, U.S. stocks coming off their lows today, in fact, near their highs of the session. Financials and industrials still leading the declines as optimism about a Trump economic boom may just be fading. We'll be speaking with senior equity strategist Dan Suzuki of Bank of America Merrill Lynch. This is Bloomberg. What you missed, despite today's decline in stocks, our next guest is calling for a 20% increase in the S&P 500 if U.S. policymakers can deliver on their 2017 promises. Joining us now, Dan Suzuki, Senior U.S. Equity Strategist for Bank of America Merrill Lynch Global Research. So when we talk fiscal or policymakers, are we talking fiscal policymakers or monetary policymakers? Because that ship has sailed.
Yeah, exactly. I think that's exactly the point, that ship has sailed. The central bank put is gone, and it's been replaced with a much more powerful put on the markets, which is the Trump put. I think that's basically the only thing that matters for the next 6 months or so.
But how do we know what the president wants to do? I mean, this is the question I keep asking everyone. Since the election, he only seems to be interested in attacking companies that manufacture overseas or other things related to, attacking costs of planes or drug prices. He doesn't seem to be talking much about the tax stuff, the infrastructure stuff that people get excited about. How confident are you that you have some idea of what an infrastructure or tax bill is going to look like in the end?
Yeah, I guess the point is it doesn't really matter. I'm actually probably more on the pessimistic front when it actually comes down to it. I think the eventual bill is going to come with more negatives than people think, more offsets. It's going to be probably more watered down and more delayed than people think. But that just doesn't matter in the next 6 months, right? So I think by the time you want to start worrying when those things start to get locked down, but that's not going to be in the next 6 months. Yeah.
So.
No, I was just going to say, I want to go back to that idea of the central bank put, right? And now that's being replaced by the Trump put.
Yep.
They are different, as you said, but the Trump put will be more powerful. What would trigger a Donald Trump put as opposed to the Yellen put, the Bernanke put?
Well, I think anytime you get some worries about growth, I mean, the reality is that we're about to go into earnings season. even if we get any signs of slowness, any weakness from companies, any slowdown in the economic data, which has actually been surprising phenomenally to the upside, anytime anybody's going to worry about that, who's going to short the market when you think that there's stimulus coming down the line 6 months from now, 9 months from now? And even if it gets delayed, those expectations are still going to be there.
I know we're not really supposed to talk about the Fed anymore because the Fed is yesterday's story.
Yep.
The administration is today's story. That being said, you mentioned the strong data. It continues to be very impressive. Today we got another impressive initial claims number. Almost no signs of weakness anywhere in the data coming out. Does the risk of a faster than expected series of rate hikes threaten the rally at all? What if the Fed actually makes do on 3 hikes for 2017 or 4 if things pick up?
Well, I think as long as Yellen's in place, and that's that case for the time being, I mean, Yellen's demonstrated time after time that she's very conservative. She's not going to do anything that's going to disrupt growth. And at the end of the day, growth is what matters for the market. So down the line, as we get into next year, maybe faster Fed hikes starts to crimp growth, and as we get the policies that may become more watered down than the market's expecting, will come a lot more of those negatives, then you may start to have to worry. But between now and the next 6 months, I just think there's a very strong support for them.
You mentioned that you think the ultimate, when bills that come out of the next Congress and this administration might be worse than people are thinking. What are the areas in which, is it related to the tax stuff, might not be as friendly to companies as people expect? Like, what could be worse specifically?
Well, the reality is, to get stuff done, you have to make compromises. And right now, the market is so focused on all the positives that are going to happen. Like, for instance, if you look at the S&P, if you just get the lower tax rate, that could add like $10 or $11 to S&P. But then half of that over time could go away if you reduce the interest tax shield, which is one of the proposals. Border adjustments could be a huge negative. And so if you keep adding on these offsets, you actually get to a point where it's actually not that big of a positive for the market. So that's the type of sort of a balance I'm talking about. Also, you've had proposals, if you want to do things on a budget neutral basis, then maybe you can't do 20%. Maybe you got to do something more like 22, 23, 24. And then, as you start making these shifts, then it becomes less and less positive.
All right, so things get watered down, certainly. One thing that Joe and I were talking about was this incredible indexes that Barry Ritholtz, a Bloomberg contributor, put together. He says that if you're going to invest in this post-Trump world, basically look at the companies in which he's praised, and he kind of put that together as an oligarchy index. That's the white line, versus the companies that he disparages through tweets and through other comments, which he calls a swamp index, and that's the blue line. And you can see the oligarchy index is up 16%, includes a lot of financials, includes Facebook, because Peter Thiel is an early investor in Facebook, whereas the swamp index includes a couple of those defense companies and the drug makers that he's highlighted or called out.
Yeah, you talk to clients a lot. Do you get a lot of questions about this, about tailoring investment strategies based on his tweets and other things like that, trying to figure out which companies are in and out?
I don't get much in terms of trying to tailor investments to his tweets, but there's certainly an element of positioning portfolios for what's going to benefit them most from a Trump perspective. And I think you really got to differentiate what the market is expecting and pricing in terms of the beneficiaries and the real beneficiaries, and how much things have run already. So if you look at the multiples for stimulus-related stocks, those stocks have more than seen more than double the multiple expansion of the rest of the market, whereas tax beneficiaries, which I think is probably the more likely beneficiary, they actually haven't seen much multiple expansion. So I think there's a lot of nuance when it comes down to it.
All right, Dan Suzuki, Senior U.S. Equity Strategist for Bank of America Merrill Lynch Research. You'll be staying with us. Next, we're going to take a deeper look at volatility in both equities and currencies. This is Bloomberg.
And just a quick mention here, we have breaking news. President Obama introducing Joseph Biden, the vice president at the moment. This is a tribute to the Bidens and to the First Lady. And if you wanted to catch the entirety of this tribute, you can check it out on Live Go on the Bloomberg.
There has not been a single moment since that time that I've doubted the wisdom of that decision. It was the best possible choice, not just for me, but for the American people. This is an extraordinary.
Scarlet. We're back with Dan Suzuki of Bank of America Merrill Lynch. Let's take a deep dive into the Bloomberg. You can find our charts using the function at the bottom of the screen. And of course, there's been a lot of volatility in FX, much more so than in equities. This is actually from your colleague, Dan, Nitin Saxena at Bank of America Merrill Lynch. The top panel shows the VIX in blue and the Deutsche Bank FX volatility in yellow. The VIX holding, of course, near 2.5-year lows. The bottom panel here is the spread between the two. And I'm just going to move it up so you can see it a little bit better. And it's actually at the widest in at least 15 years. So we've seen flash crashes in the pound. We've seen wild swings in the peso, relentless pressure on the Turkish lira, unexpected moves in the offshore yuan. Equities, everyone's like, yawn. Why is there so much complacency in equities?
I think part of that goes back to the Trump put. I mean, if you have the Trump put, you don't have to worry about anything, any of the fundamentals. The other thing is, outside the U.S., I mean, everything's rosy in the U.S., but as you look at what's happening in these individual countries, there's a lot of volatility going on. You got Brexit, you got concerns around, what's going on in Italy, you got worries next year about the election in France. There's just a lot to be concerned around. Half of emerging markets are still just coming out of a recession. So there's a lot more volatility outside the U.S. So I think it makes a lot of sense.
So basically, Trump takes care of U.S. equities, but nothing else falls under that umbrella. Everything else is just a world of chaos out there.
To some extent. I mean, rising tides raises all boats, but on the margin, I think that's definitely true.
All right, here's one trade I'm looking at that's faded a little bit if we go into the Bloomberg. It's the correlation between treasuries and financials. And, of course, right after the election, we saw both financial stocks and long-end rates shoot up. Because, of course, when rates go up, that banks are expected to make more money, higher earnings. Also, there's some expectation that banks would do well under Trump due to an expected regulatory rollback. But as you can see here, if we go, that actually doesn't show that well. I'll just leave that below the chart. You can see that they've diverged lately. Interest rates have really pulled back in quite a bit, back to levels we haven't seen since November. Yeah. And financials have held up. So is there more room for financials to run, or is this trade inevitably going to sort of sputter out as long as rates are sort of languishing here?
Yeah, I think there's two things going on. I think just as you pointed out, it's not just the financial story is not just a rate story. I mean, there's a lot of other factors that support financials continuing to outperform, which is why I think you're seeing it outperform today. But I think in addition to that, there's still further upside for rates. So I think they pulled back a little bit. But I think over the course of the year, you're going to see rates go higher, and that'll also help catalyze financials performance. So, it's not just a rate story, but I think rates will become supportive later in the year. But in addition to that, you got the deregulation and all the other positives that financials have.
All right, Dan Suzuki, Senior U.S. Equity Strategist for Bank of America Merrill Lynch Global Research. Thank you very much.
And we have some breaking news from Jim Comey, the director of the FBI. He says that he is grateful to the Justice Department's Inspector General for opening this investigation into whether that agency followed appropriate procedures when it investigated Hillary Clinton's use of private email while she served as Secretary of State. Remember, that timing of the disclosure that he was reopening the case became a huge problem for her and a huge point of contention during the campaign overall. Comey says that the DOJ auditor is professional and independent. He also adds, Jim Comey does, that he will cooperate fully with the DOJ review. Again, Jim Comey grateful to the Justice Department Inspector General for this review. This is according to a statement released by the head of the FBI. The market close is next. Take a look at the major indexes with less than 4 minutes to go before the close. away from the closing bell. What'd you miss? U.S. stocks and the dollar slumping a day after President-elect Donald Trump failed to provide policy details in his speech. 10-year yields touching their lowest since November. I'm Scarlet Fu.
And I'm Joe Weisenthal. If you are tuning in live on Twitter, we want to welcome you to our closing bell coverage, which is every weekday from 4 to 5 p.m. Eastern.
We begin with our market minutes. 6 out of 11 major groups in the S&P 500 finished down, but I feel like that doesn't tell the whole story here because the indexes took a dive in the early going, the first 2.5 hours. Earlier. And since around 12 p.m., 11 a.m., 12 p.m., they've pretty much been on a straight path higher. It's been a pretty remarkable pairing of those gains.
Yeah, Dow was down over 170 at one point, so this is pretty minor losses in the perspective of the day.
Exactly. However, one sector I want to highlight here are the biotechs. They recouped some of yesterday's plunge. That was, of course, sparked by Donald Trump's vow to crack down on high drug prices. I believe he used the word they're getting away with murder. And you could see that if you just looked at today, sure, they made a big comeback. But over the past 2 days, they're still down about 2.5%. Also under pressure today, at least, is chip makers. Chip makers. You could see the Philadelphia Semiconductor Index off by 0.9%. I highlight Apple here because it is one of the big drags on the Dow Jones Industrial Average. A federal appeals court in San Francisco ruled that a class action lawsuit versus Apple can move forward. According to the suit, Apple's control over its App Store violates U.S. antitrust laws. So we'll certainly be keeping our eye on that.
And let's get a look at government bond markets around the world. Yields lower across the board, modestly lower in the U.S., although they had been, the 10-year yield had been significantly lower, closer to 2.3 earlier in the day during the worst of the equity markets losses. And I want to spotlight that Turkish 10-year yield because we talked about it yesterday. It had shot up. Today was a bit of a comeback for Turkish, the Turkish lira and so forth. So nice decline on that front.
All right. I'm glad you bring up the Turkish lira. It's something we certainly have been keeping a close eye on here. The dollar weaker versus most G10 currencies, except versus the pound. You could see there, well, actually now things have changed again. The pound initially lost value on an announcement that Prime Minister Theresa May will lay out her Brexit version in a speech on Tuesday. If you look at a 3-month chart of the 1-week volatility on British pound, it shows that it's been moving higher because Theresa May has signaled that she is likely to seek out the hard Brexit option.
Theresa May now represents pound risk, so traders get nervous.
That's a really good point. Another currency pair that I was keeping a close eye on is the Swedish krona. It strengthened versus the euro after CPI came in higher than expected. It edged closer to the central bank's 2% target, which could mean that an end is in sight for the Riksbank's stimulus program. But if you look at a 3-month chart, here's where the problem comes in. The krona has been appreciating in value versus the euro for the last 2 months, and a surge in the currency could be problematic because it would lower inflation. That would get in the way of the Riksbank ending QE. So I don't know, it's a little bit of both, right? You're
kind of like the issues here in the U.S. in a way.
Good point.
All right, let's look at commodities. First, starting with oil and gold. Really not much going on in either market, but oil rising back above $53 a barrel. That's West Texas Intermediate crude. The real action today was in the grains market. Let's look at wheat, soybeans, and rice. All green on news from the USDA about lower than expected farm planting. So you see a bullish day in the grain markets. There you go.
All right. Those are today's market minutes. What'd you miss? Donald Trump yesterday gave investors little reason to add to their bets that have boosted the dollar and U.S. stocks to records. But the president-elect did make the pharma industry cringe when he criticized drug pricing. The Nasdaq Biotech Index, as we told you, plunged. And, of course, even though it's made a recovery, still down. The bottom line here is Trump moves markets. Joining us now is Scott Minerd, Global CIO at Guggenheim Partners. Scott manages $250 billion in assets. So, Scott, how do you position yourself, or do you bother positioning yourself around Trump's various pronouncements?
Well, I mean, I think that's pretty hard, right? I think we have to take a longer view with the Trump policies, which are, given the likelihood that we're going to get further deregulation or a slowdown in increased regulation, and then on top of that, the possibility of a tax cut and fiscal stimulus, this is a pretty potent mix for the economy, and should translate into higher equity prices. I would expect to see the S&P at the end of the year maybe around 2,450 to 2,500. But in the near term, we've come a long way pretty fast. And I don't think any of us should be surprised to see the market take a pause here and digest and maybe correct and and try to establish a base to move higher.
What about the fact that Trump lashes out at any time a company does something that's politically unpopular? Yesterday, obviously, he took a shot at the drug companies. Pharma doesn't like the prices that they charge. He attacked aerospace companies because he thinks they're too expensive. The investment plans of car companies are now under threat. Who knows where he's going to go next? How do you weigh some of that risk?
Well, you know, I think that the key to the success of the Trump program, economic plan, will be not to get bogged down in minutia. And so, you know, if the president-elect,
even though it seems like he is,
well, that's the question, right? If the president-elect allows himself to be sidetracked by a lot of micro issues in the economy, it's going to make it very difficult for him to move forward on all the programs and plans that he has. So, you know, the president-elect has put a pretty full agenda on the table to be addressed, and the question is now, in my mind, can Congress digest it all? I think that's going to be a real challenge.
Right. Can they pick up the baton and run with it? That's the equity perspective.
Right.
Let's go to bonds for a moment. Why are bonds falling, prices falling, and yields rising? I mean, is it because of inflation expectations?
I actually think when you look at the strengthening dollar, you look at the fact that commodity prices have been relatively stable, it's telling you that there's an expectation that real growth or potential growth is improving. It's not because inflation is rising. And so if I saw the dollar weaken dramatically, I think that would change my perspective. But, you know, an appreciating currency with rising interest rates is classically associated with an increase in real growth, not an increase in inflation.
You know, obviously we've seen a little bit of tick up in rates since the election, really since this summer, but the long-term trend is still, you know, incredibly low by any sort of historical standards. Are we seeing a real shift that's going to change this long-term trend, or is this just another one of the upward uplifts on a long road down?
Well, you know, I always like to tell clients that I try to let the data tell me the story rather than try to come up with a story and fit the data to it, right? So, look, we've been in a 35-year bull market. Interest rates have gone down since the early 80s. That trend is solidly in place. We would need to see the 10-year note get up to around 3% for that to violate a long-term trend. Even if we do violate the long-term trend, you don't reverse trends like this on a dime. So in all likelihood, you know, rates would stay relatively contained and come back down, but it would certainly be a sign that the sea change is in place and that over the next 20 to 30 years, we're likely to see higher rates.
We're talking about politics. I just want to jump in here with a headline from Bloomberg News, which is Skybridge's Anthony Scaramucci is said to join the Trump White House. Our reporting indicates that he will be named an assistant to the president. Again, Anthony Scaramucci said to be named assistant to the president when Donald Trump is sworn in. Let's go back to your call about 3% and the 10-year yield. Jeffrey Gundlach, of course, has said that if the 10-year yield gets to 3%, that means the bond bull market is over. Bill Gross says 2.6%. Are you saying that when we violate the long-term trend, that means the bond bull market is over?
It's basically the beginning of the end, right? As I said, you know, long-term trends like this don't reverse quickly. I think that there'll be another, you know, as the business cycle ages, and in 2019, 2020, when we could anticipate we might have another recession, that there will be another deflationary burst that would bring rates back down if we do get up above 3%. But we haven't violated that trend yet. And so I'm hesitant until the market starts to tell me that we violated a trend to start anticipating it. But once we do violate the trend, then we know that we're going to be spending a number of years building a base that will lead to higher interest rates.
You know, I was just thinking about this Scaramucci news that we got, and are you surprised by the degree to which people in the financial industry, including many people with a history at Goldman Sachs, a firm that was specifically vilified on the campaign, Hillary Clinton was tied to it in a negative way, are finding a home and finding a receptive welcome in this new administration?
Well,
Did that catch you by surprise?
No, not really. I mean, if anything, Donald Trump is an iconoclast, right? He breaks images. And, you know, the fact that he has wanted to surround himself with people who've been successful in virtually all kinds of industries, it doesn't surprise me that he's bringing people in from the financial community also. So it is the one interesting thing here is from a historical perspective. I can't recall a time in U.S. history, with maybe the exception of sort of the Calvin Coolidge, Herbert Hoover era, where business was so front and center. I mean, even Ronald Reagan, who was a very pro-business, pro-growth candidate, didn't have a cabinet full of business people. Right. This is the first time that I'm aware of that we've actually taken business professionals and putting them into cabinet jobs, not experienced political people.
So this is a complete sea change, speaking of sea changes, from the previous administration where we had a lot of academics.
Right.
What kind of people does Donald Trump need to bring on then? He's brought on a lot of business people. Are there people that he hasn't brought on that he should?
Well, I think that the administration would do well to have some academic in the administration, people who
There's
understand.
Peter Navarro, to be sure.
Well, that's true, but I think, you know, we might want a deeper bench, right? Not to say that Peter's not capable, but, you know, having a few more people who have some deeper understanding of how economics work, because economics and business are two different things. I know a lot of successful business people who have executed successful business plans that didn't really understand much about economics at all. And then the question for an administration like this is what policies make sense for the economy in the long run, not what's going to work in the short run.
All right, Scott Miner, Guggenheim Partners Global CIO. Stick with us because we're going to pick your mind about the Fed. He just came from a New York Fed meeting where he's an advisor. This is Bloomberg.
I'm Elisa Parenti. Let's get to Bloomberg's First Word News. An investigation is underway by the Justice Department's Inspector General. It's looking into whether the FBI followed proper procedures in its probe of Hillary Clinton's use of a private email server while Secretary of State. The review will look at what led FBI Director James Comey to decide to not pursue charges. Investigators will also review Comey's announcement that he was reopening and then closing the investigation just days before the November election. Comey says he's grateful for the review and that he'll fully cooperate. CIA nominee Mike Pompeo took a tough stand against Russia today during his confirmation hearing. The congressman appeared before the Senate Intelligence Committee in the face of a testy standoff between President-elect Trump and the intelligence community over Russian hacking.
This is very real. It is growing. It is not new in that sense. But this was an aggressive action taken by the senior leadership inside of Russia, and America has an obligation, and the CIA has a part of that obligation to protect that information.
Pompeo says Russia has reasserted itself aggressively in invading and occupying Ukraine, threatening Europe, and doing, quote, nothing to help defeat Islamic State. The United Nations envoy for Syria says a ceasefire is, quote, largely holding with some exceptions. Opposition activists are reporting a growing number of airstrikes. Officials are concerned the fighting will further derail proposed talks aimed at ending Syria's civil war. And British Prime Minister Theresa May will outline her vision for leaving the European Union in a speech Tuesday. She'll try to answer calls from businesses and politicians who want to know her goals for Brexit talks. Those negotiations are due to begin by the end of March. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg.
Scott Meinert, Guggenheim Partners Global CIO, is still with us. Scott, you're also an advisor to the New York Fed. We aren't talking as much about the Fed as we used to because so much of the attention has shifted to the administration. Nonetheless, 3 hikes currently expected, at least per the dots, in 2017. What do you expect, and how does Fed policy still affect the markets from here?
Well, it's interesting you say that. I think all we had to talk about was the Fed for like 7 years.
That really was it.
Look, the Fed is running the risk here of falling behind the curve. When you look at their projections of where unemployment will be at the end of the year, I can't quite agree with where they stand. They're expecting unemployment to be around 4.6%. The reality is if we have job growth in line with what we had in the past, it's going to take a dramatic increase in the participation rate to keep the unemployment rate at this level. So I think that by the end of the year, we're going to be approaching, the 4% threshold. In addition to that, the dots, the market's not basically priced even to where the dots are for 3 rate increases. And I think the risk is that we're going to find that 3 rate increases may not be enough by the time we get to the end of the year.
So what happens if the markets... What happens if everyone's caught by surprise? Wages really keep picking up. The inflation data that we see continues to go. The Fed says, maybe 3 dots isn't enough. What does that do to overall markets?
Well, I think that you're vulnerable then to a tantrum in the market where we would get a sell-off in long yields. And an increase in long-term rates would be, not a good sign. So my view is that the Fed should probably take a more aggressive posture and get started as soon as possible. I believe they should I think they should move in March to get started. At this point, the market's priced, for a 4 basis point increase in March, which means it's not priced an increase in at all. And so, I doubt that the Fed shares my view, but they also have told us they're data dependent, and so March could be on the table, but I don't think they're going to get there.
So you're more hawkish than the Fed, which sees 3 rate hikes. You're looking for 3 or 4. Yet earlier you were saying that inflation fears are overdone. So what would compel the Fed to move?
Well, it's this increase in what's called the natural rate or the neutral rate. That is that as you reduce regulation and you increase spending and you reduce taxes, that increases the potential output for the economy. So this real pickup in economic activity should be associated with an increase in interest rates. If you start to fall behind the curve, then you start to raise questions about longer-term inflationary expectation. And, the Fed has done an incredibly good job over the last 30 years of hemming in inflationary expectation, and I think they would hate to give up that well-won battle at this point.
Well, you're not the only one who says the Fed's behind in the curve. John Taylor, for instance, has said as much, and he's seen as a possible candidate.
Right. Also, a possible replacement for Yellen. Who do you think? What do you think about some of the names that have been bandied about as possible Yellen replacements? Glenn Hubbard, John Taylor, Kevin Warsh. All three, their names have been in the news. I think they were all on a panel recently, or some of them, about the Fed. Some people seeing it as like part of an audition. Who do you like for that position?
Well, certainly John Taylor is a highly respected guy. He, I think, would make a good, strong academic. We were talking about academics before. But Kevin Warsh, Kevin was on the Board of Governors before and is a capable fellow. He comes more from the business world, having worked at Morgan Stanley. So, I think both of them would be very, very good candidates to be chair.
Do you worry at all about a potential conflict this year or between now and the end of Yellen's term between the administration and the Fed? For a long time, just the White House didn't comment on Fed policy, but Trump doesn't seem like the type that would necessarily hold back if you perceive the Fed to be slowing down his recovery or impeding the market in some way. Do you see that as a risk?
I think that we're to expect it. That if he disagrees with the view of the Fed chair, he will have no hesitancy to express that. I do believe on the other side of the equation that Janet Yellen is extremely committed to the independence of the Fed, and that theories that are out there that Janet Yellen will resign, I think are dramatically overblown. I think that because of her strong feelings about Fed independence, if she did resign, I think she would be concerned that would send a signal that there was some lack of independence. So I think we could have an interesting year or so until the end of Chair Yellen's term ending, and that would make for good entertainment.
Certainly.
Agreed.
All right, Scott Minerd, Guggenheim Partners Global CIO, you're sticking with us. When we come back, how Sweden's inflation is bringing some much-needed relief to the Riksbank. This is Bloomberg. I'm Scarlet Fu. We're back with Scott Minerd of Guggenheim Partners. Let's take a deep dive into the Bloomberg. You can find the charts using the function at the bottom of the screen. And I want to start with the global reflation story. There's some more evidence of it, this time coming from Sweden. So the white line is the CPI. It's picked up for a third straight month. Now 1.7%, the highest in almost 5 years. The blue line is the underlying rate of inflation, which is adjusted for mortgage costs. And that's at 1.9%. The Riksbank looks at that one pretty carefully as well. Riksbank has a 2% target. That's that yellow horizontal line. It's been more than 5 years since the central bank has met that 2% target. Is this credible, the global reflation story that we're seeing across the world?
I definitely think so. I mean, one of the big factors is the dollar rally. As the dollar continues to strengthen, that raises prices elsewhere in the world. It allows domestic producers to raise their prices in their local markets. And so a strong dollar is good for the global reflation story, and I think we're just getting started.
So it's the real deal.
It's the real deal.
All right, here's another story, and we kind of talked about this before. Trump, he likes to tweet a lot. And one thing that he likes to tweet about a few times, issues relating to Mexico and the wall. And there's a great story on the Bloomberg today. You should check it out, about how some traders would like the government of Mexico or the Central Bank of Mexico, instead of spending money to intervene and prop up the peso, to just buy Twitter and shut it down.
Buy the company?
Yeah, buy the company Twitter and just shut it down. It might actually just be a really good thing for the world beyond the peso, to be completely honest. Although, if you're watching this show on Twitter, of course, you couldn't do that. So
maybe the Mexican government will be the new owner.
Don't do it for that reason. Anyway, you can see how sometimes Trump tweets about it, and then you get this peso volatility. How do you think? So I'm just curious your take on this in terms of like Trump tweet risk and currencies and all this stuff. This just must be no investor has ever dealt with anything like this before.
Well, it's interesting. I mean, you back away from it a little bit, and you see. The Trump revolution is pretty impressive, right? We have never had a complete outsider from government become the president of the United States out of the blue.
Sure.
And he did it really heavily off the back of social media. Mm-hmm. And so I think, you can say that Trump has revolutionized the way this works, or you can say social media has revolutionized it. And, I find it interesting that the president-elect uses social media as the means to communicate policy statements. But, on the other hand, he clearly is a populist. And, populists want to get directly to the voter base.
We're probably not ever going to go back to a time when a president can get that much power without being very versant and comfortable on social media. I mean, this is probably like the start of a new thing.
Well, it is. But, our country's gone through this before. An interesting fact a lot of people don't know is that Andrew Jackson, 7th president of the United States, was the first populist president. He was the first president to ever campaign. Every president that succeeded him or preceded him had been the Secretary of State before he became president.
Oh,
so we've gone through these kinds of revolutions before. And so the Trump revolution has changed the way politics in America works. And, Joe, maybe you could run for president when you start tweeting.
Well, he does have more than 100,000 followers on Twitter.
So
really?
I'm well on my way.
You're on a good start.
All right. Scott Minerd, Global CIO of Guggenheim Partners. Thank you very much for joining us.
Thanks, Joe.
All right. We wanted to bring you back to the White House, where President Obama is paying tribute to the Vice President, Joe Biden. And if you wanted to catch the entirety of this tribute, you can catch it on Live Go on the Bloomberg. It has just actually wrapped up, as we've learned. But Joe Biden, again, being paid tribute, I should say, by the president. He also paid tribute to the First Lady, Michelle Obama. Coming up, JP Morgan is set to release earnings tomorrow. We will take you into the numbers and break it all down for you. This is Bloomberg.
I'm Elisa Parenti. Let's get to Bloomberg's First Word News. FBI Director James Comey says he will cooperate fully with a Justice Department investigation. The DOJ's Inspector General is reviewing whether the FBI followed proper procedures during its probe of Hillary Clinton's use of a private email server while Secretary of State. The probe will examine Comey's decision not to pursue charges against Clinton. Comey's announcement that he was reopening and then closing the investigation just days before the presidential election will also be reviewed. Democrats say those moves damaged Clinton's candidacy. Retired General James Mattis could become the first career military officer in charge of the Pentagon since the 1950s. Today, at his Senate confirmation hearing, the former Marine targeted Russia as a strategic adversary.
I think right now the most important thing is that we recognize the reality of what we deal with Mr. Putin, and we recognize that he is trying to break the North Atlantic Alliance, and that we take the steps, the integrated steps, diplomatic, economic, military, and the alliance steps, the working with our allies to defend ourselves where we must.
Meanwhile, Skybridge Capital founder Anthony Scaramucci has been named an assistant to President-elect Trump. That is according to people familiar with the decision, who say Scaramucci will have a general advisory role in the White House. Rick Perry will go before a Senate panel next week for his confirmation hearing. The former Texas governor is President-elect Trump's nominee for Energy Secretary. As the longest-serving governor in Texas, Perry was an advocate of American energy and oversaw a state that's a powerhouse in fossil fuels and renewables. And President Obama paid tribute today to Vice President Joe Biden, praising him as an extraordinary man with an extraordinary career in public service. At the White House with Biden by his side, Mr. Obama said his selection of Biden as vice president was, quote, the best possible choice, not just for me, but for the American people. Obama also awarded Biden the Presidential Medal of Freedom. That is the highest honor a civilian can receive. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Joe?
All right, let's get a quick recap of today's market action. As you can see, right across the board for the major equity indices, but nothing too major. In fact, we were down by much more earlier in the day. At one point, the Dow Jones Industrial Average was down close to 180 points. A big comeback, kind of a similar story in government bond yields. We saw a big decline in yields earlier in the day, but then a bounce back up, so a modest decline. Scarlet, you're looking at J.P. Morgan earnings J.P. Morgan numbers ahead of the earnings?
Yeah, that's right. J.P. Morgan, Wells Fargo, and Bank of America will all be reporting earnings before the U.S. opening bell on Friday. Interest rates, the incoming Trump administration, Brexit negotiations will all be key drivers for banks in 2017. But before we can really move forward, we have to look back at the quarter that was. In today's The Numbers Don't Lie. Wall Street firms are expected to post the biggest fourth quarter trading haul since the financial crisis. And you can see here some of the major banks and the eye-popping gains they posted in fixed income trading in the third quarter, all up by at least 35%. Now, analysts expect this trend to continue in the fourth quarter with an estimated average 32% surge in bond trading revenue. Global investment banks are on pace for their first annual bond trading revenue increase in 4 years. Now, when looking at J.P. Morgan in particular, the bank saw a 48% year-over-year gain in fixed income in 3Q. That is your white line and a steep move up at the very end. Those trading gains, along with Trump's surprising election, have pushed J.P. Morgan and other bank shares higher since November 8th. Now, the Trump White House is potentially offering less regulation and lower corporate taxes. And don't forget, the Fed also raised interest rates last year. At J.P. Morgan's last investor day, almost a year ago, the bank broke out how higher rates would boost net interest income. Looking at the different scenarios here, the white line shows a 25 to 100 basis point increase would result in $10 billion for the net interest income by 2018. If rates increase by 0 to 25 basis points, J.P. Morgan could make $6 billion. And if rates stay flat, that is the blue line at the bottom there, the bank would make $4 billion in net interest income. Now, since the U.S. election, we've seen the move up in the 10-year Treasury yield, and that is the white line there, which could lift the bank's net interest margin, which is the orange line, started to come up a little bit. That, of course, as you know, in perspective, has struggled since the financial crisis. Morgan Stanley President Colm Kelleher last month told us that it's still too early to declare a lasting rebound in Wall Street trading revenue and that there was a bit of, quote-unquote, over-exuberance. We'll, of course, be getting more color when J.P. Morgan and its peers release earnings before Friday's opening bell. Joe?
Thanks, Scarlet. What'd you miss? Today, the Federal Reserve released full transcripts of 8 meetings from the 2011 Federal Open Market Committee. Joining us now to help break them down is Bloomberg's Matt Boesler. Now, Matt, these are the transcripts, so they're not the minutes. We always get the minutes not long after each meeting. There's sort of a rough outline. But this is the word-for-word conversation, basically, that they had in 2011, which was a pretty wild summer. If people remember, we had the debt ceiling fight, Eurozone crisis really starting to get going. So what was your big takeaway from reading all these meetings?
Yeah, so I really homed in on that August meeting right there in the middle of the year because that was just, they had just gotten to the table right after S&P had downgraded the U.S. credit rating, if you recall. Markets were going into a bit of a tailspin, and so things were getting messy, and the outlook was pretty uncertain. And I think we have a chart that illustrates this really well. If you look at what markets were pricing in terms of Fed tightening that year, you can see that this highlighted part in the middle shows that in the first 4 months of the year, people were expecting liftoff to come fairly soon. This white line shows the percentage points of Fed tightening that are priced for the coming year. And so through the first 4 months of the year, there was definitely that building expectation that there would be an exit fairly soon. But then you can see starting around April and then going into August. August is kind of the bottom of that chart where it really plunged because the debt ceiling thing, the euro crisis, a slowdown in the economy. They had just gotten really negative GDP revisions, really soured the entire outlook. And so I think it just kind of speaks to how surreal that summer really was. And we also have a good quote from Dan Tarullo at that meeting where he was basically saying, look, I'm making a plea here to my colleagues.
Let me read the quote. He says, I asked to go first today. This is from the August 9th meeting, so still at the time you're talking about. He says, I asked to go first today, not to parse economic data so much as to talk about cognitive dissonance and specifically to make a plea to all of us how important it is to resist the temptation that we all naturally feel to cling to our own past beliefs and prescriptions. I think that meaningful debate today is whether even a weak and halting recovery can continue or whether we're already at or below stall speed and quite possibly slipping into another recession. Quite a dramatic thing, the idea that, and other people thought this too, that in 2011, people thought the recovery was over.
And this was the conversation going on at the table inside the Fed. I mean, it was a scary time for them, and this just kind of highlights that. And you look at it and some of the things that were going on at that time, and it's a little bit reminiscent of today. So obviously the economy is in a much better position today. We have a much stronger economy, but there's this real sense of uncertainty going forward about what's going to happen next, right? And the things that they're grappling with today, for example, how to incorporate fiscal policy into their models for their forecasts about the economy, they were having those exact same problems then. They didn't really know how to do it. They didn't really know how to incorporate financial market developments into their models. And that was far and away the biggest thing that was going on at the time. So just mass confusion.
Mass confusion, and that quote from Tarullo is really eye-opening because it's so candid in questioning some of the central beliefs there. Was this universal? Did other policymakers feel that way as well, or were they more confident of how they would proceed?
There was definitely a flavor around the table of pessimism, concern. Tarullo was probably a little more pointed in his remarks than a lot of others. A lot of others were saying, well, on the one hand, like these GDP revisions we just got have been discouraging. The drop in the stock market is looking pretty scary, but, we're not sure we're ready to conclude that we're necessarily slipping into another recession at this point. Of course, they had just ended a big stimulus program in QE2, and then a month later they ended up launching a new one in Operation Twist. So they definitely did, come around to the conclusion that they needed to do more quantitative stimulus, and that's ultimately what they did.
A topic that I'm very interested in, the debt ceiling, particularly the run-up to it. All kinds of speculation about what the Treasury and or the Fed might do in contingency for a debt ceiling breach if they hadn't gotten that deal in early August. Did we learn anything about that from the transcripts?
Yeah, so this is a story that's been going on for the last 5 years because, as you know, Congress was pretty upset about, the idea that Fed and Treasury were sort of, doing these things behind the scenes that they weren't keeping Congress up to speed on. And so what we learned today is that the Fed had a very detailed plan for how to prioritize different interest payments, depending on what the Treasury was going to do. And the Fed was very confident that even if Treasury didn't stick with the plan that they had told the Fed they were going to follow, the Fed systems would be very adaptable to whatever Treasury threw at them. But what they were really concerned about was the private sector systems, like the private banking system, for example, which they felt were not adequately equipped at all to deal with, certain contingencies. So that's what they were really concerned about was, the impact that a potential, spanner in the works by the Treasury or Congress would have on the private sector, and that could have, been disastrous.
All right, Bloomberg's Matt Boesler did the work of going through hundreds of pages of transcripts. Thank you very much.
Thank you.
Coming up, the South China Sea debate continues to heat up. Secretary of State nominee Rex Tillerson says the island building must stop. We take a look, or we consider, China's reaction next. This is Bloomberg. What you missed, China is pushing back after President-elect Donald Trump's nominee for Secretary of State Rex Tillerson warned this week about the disputed South China Seas.
We're going to have to send China a clear signal that first, the island building stops, and second, your access to those islands is also not going to be allowed.
And today, retired Marine General James Mattis, Trump's nominee for Defense Secretary, was more cautious.
International waters are international waters, and we've got to figure out how do we deal with holding on to the kind of rules that we've made over many years that led to the prosperity for many nations, not just for ours.
Joining us now to discuss China's response to comments from the incoming U.S. administration is John Liu, Bloomberg News Beijing bureau chief. John, thank you very much for joining us.
My pleasure.
Great to have you on set here. So, obviously, this new administration making lots of noises, really threatening to upend the existing relationship in various ways between the U.S. and China. So far, how is the new administration being perceived in China and in Chinese media?
Well, I think everybody's taking a wait-and-see attitude. I think, what Trump tweets is not necessarily what Trump does. I think people understand that. So I've talked to people in Beijing, and they'll say, look, there is a certain level of uncertainty that he brings, but we think when he gets into office, he'll be a deal maker because he's a businessman. So they hope for a pragmatic president, but is that what they'll get? I think they're waiting to see.
What's your impression of Obama as he gets ready to leave office?
Well, I think there's been pretty mixed feelings about Obama, and there weren't loving feelings about Hillary Clinton just because they thought the pivot to Asia helped inflame some of the tensions in the South China Sea. And so I'm not sure that they would have preferred Hillary over Trump.
I ask this because however they feel towards Obama kind of sets the stage for how they perceive Donald Trump.
I think that they perceived Obama as being predictable, like a continuation of U.S. policy, whereas Trump is, who knows, right?
So even though, in terms of his rhetoric, Trump clearly seems to be more antagonistic towards China than either Hillary Clinton or Barack Obama, there's some view in China that perhaps maybe he's someone that the country can ultimately work with.
Yeah, I think they're hoping they can make a deal. And they're looking at Trump as someone who would be willing to make a deal. I think it's actually quite interesting, outside of Mathis speaking today, the party secretary of Vietnam is actually in Beijing today. He had a meeting with Xi Jinping overnight. So Vietnam and the Philippines are obviously the main claimants to the island, and they seem to be coming to some sort of agreement, Duterte and the Philippines. So I don't know how everything's going to work out. I think, the TPP being taken off the table, I think changes the calculus for everybody.
And there might be a little bit of a vacuum there, and China can kind of step in as well. Yeah. A lot of political bluster, obviously, here in the United States, especially as we wait for Donald Trump to be sworn in. Is there that same level of political bluster before leadership conferences like in China later this year?
Is there? I don't know. There might be, but we don't see it.
Does it transpire the same way in terms of how it trickles down to the economy and companies?
No. I think the way it affects the economy is that there is great demand for stability in a year of political change in China. So I think what you are going to be expecting is calmer markets, lots of efforts being taken to not have what happened last year at the start of the year.
No tantrums.
No tantrums, right? China doesn't want anything to be out of order in this year and just for everything to go extremely smoothly.
So does that extend to how it behaves towards Taiwan?
So I think there's a pull and push there because domestically, the government can't be seen to be taking a weak position on Taiwan. And so they don't want there to be increased tension, but at the same time, they cannot appear to be weak on that matter.
So going into this leadership, this new Congress, what should, people who aren't familiar with the Chinese political system and how it all works, what are the key things along the roadmap we should be paying attention to? What's the key ideas here?
So the key things are at the end of the year, there's going to be a party Congress. And so there's a 7-man standing committee that rules China.
Men with really black hair.
Yes. Generally, traditionally, there's an age limit of 68. So anybody over 68 doesn't continue on to the next term. So of the 7, 5 are over 68. So on that basis, you would think that 5 of those gentlemen would retire and we get 5 new people. And so the only 2 people who are under 68 are Xi Jinping and Li Keqiang, the premier. So you kind of expect 5 new people on the standing committee. Who those people are, we're not really sure. I mean, there's a small cohort of potential people. How it affects overall policy, I would expect continuation. And Xi Jinping's really gotten a stranglehold on power, so I wouldn't think that there would be a dramatic shift in the direction that the country is taking.
And we talk about how Obama looks at the long game. He really looks at the long game.
Yeah, I would say so.
John Liu, Bloomberg News' executive editor for Greater China. Thank you so much.
Up next on What'd You Miss? Much more from our exclusive interview with Kelper's CEO, Ted Iopoulos. His thoughts on reducing external managers in favor of in-house ones. This is Bloomberg. What'd you miss? We want to bring you more of that exclusive interview with Kelper's Chief Investment Officer, Ted Eliopoulos. America's largest pension fund is making a bold move to reduce fees, developing plans to shift from external managers to internal. Bloomberg's Eric Schatzker asked more about the specifics of the plan.
It's a difficult space in the stock markets to be an active investor. They're very efficient. We have brought just about a huge majority of our assets internal. We're very proud to have over 70% of the CalPERS portfolio we manage internally, and most of that is in our public asset classes, stock and bond. Much of that in the stock portfolio is index oriented, but 30% of the portfolio is pursuing various active strategies. Some of that we do internally, and we have about 20 external managers that deploy a range of active strategies.
If you could do everything you want to do, what would that 70% number be? You would manage in-house what percentage of CalPERS assets? Would it be 100?
No, I don't think, no, it wouldn't be 100. The private asset classes pose a business model challenge. We have one office here in Sacramento. We're happy that you're here visiting us here in town. But looking at the private markets, real estate, infrastructure, private equity, much of that is a very local business. Very, very important to know not just the local markets in the United States, but across the globe. And in order to build an internal capacity to invest in the private markets, you have to plan for and be really sure you can execute a
Other
direct
pension plans
model.
have done it. Ontario Teachers, for example, Canada Pension Plan Investment Board, and I could name more.
Sure. Now, the Canadians and sovereign wealth firms have been successful in building out internal teams to do that. The United States pension plans, not so much. And
is that because you can't pay for the talent?
That's part of it. Part of it is our governance structure being so intertwined with the public agency of, in our case, the state. It limits some of the things that we can do, both in terms of compensation and otherwise, and opening offices and developing strategies across the globe that you really need to think through. The Canadians were able to solve some of those problems
with governance
legislation,
changes,
with governance changes, and I think that's really a prerequisite. We're looking at other ways, perhaps, that we could achieve some of the objectives that the Canadians and others have done without going to a completely direct model.
What kind of structure would work there?
Well, we're looking at whether or not we could create or invest in a private operating company that could, in turn, build out those capacities. So it'd be a more indirect way of doing that, but would be a special purpose vehicle that would be able to build out all of those capacities that I mentioned and be able to...
So still compliant with governance, still compliant with state legislation, but functionally something of an end run.
Yeah, it's functionally a separate entity that will allow it to succeed.
And let's go back to that question then. 70% now. If you had your druthers, CalPERS would manage what percentage in-house?
I think 75%, maybe 80%, somewhere in that.
So that's bringing billions.
Billions of dollars more in.
Pulling that lever is a multi-billion-dollar decision.
It's a big deal, and you can see that 70% that we have in-house currently, we pay 4 basis points for that talent. And we've done very well in the fixed income and global equity portfolio with attracting talent. Very proud of the teams that we have here in Sacramento. They've performed quite well over long periods of time, and it's a great deal for the California taxpayer to be able to invest $220 billion at minimal basis points is a fantastic bargain. But before we employ more of that strategy in the private markets, we have to make sure we can compete.
And we have some breaking news on Morgan Stanley. According to Reuters, the firm is cutting bonuses for investment bankers by about 15% and firing about 20 managing directors because fees declined last year. Now, this is part of the annual performance review, the layoffs in general, but there were more than usual, according to Reuters. We'll keep you posted on any further developments. Coming up, what you need to know to gear for tomorrow's trading day. Looking ahead to tomorrow, don't miss this. China releases its December exports and imports numbers, so of course its trade balance overnight.
And I'll be looking at December retail sales coming out for the U.S. at 8:30 a.m. Eastern Time. Economists looking for 0.4% growth, up from 0.2% last month.
And earnings from the big banks. So you've got Bank of America, you've got J.P. Morgan, and you've got Wells Fargo. All that coming up tomorrow. That's all for What You Missed. Thanks for watching.
Have a great evening. This is Bloomberg.
Hi, my name's Ashley.
Hello, Ashley. I am a socially intelligent robot.
Ashley Vance is going to the farthest corners of Earth.
This is the UFO. What am I going to find inside? You get Wi-Fi out here?
To find the mad scientists, the tech geniuses, and the dreamers of tomorrow.
It's about high-tech innovation and doing really, really clever things.
Hello, world. Friday on Bloomberg.
Changed yesterday. This got ever steeper. Are the markets ahead of the Fed or are they behind?
It's not risk